Well, consumers are losing that pep in their step. Retail sales in October turned negative for the first time since March. Now, this could be a win for the Fed as it signals a slowing in demand as we approach the last FOMC decision of the year. Let's break down how data like retail sales impacts the Fed with our very own Jared Blikre. Hey, Jared.
That's right, Rochelle. As you said, retail sales did just drop into negative territory, but they were down about 0.1% in October. But there's evidence that the consumer remains strong, something the Fed and policy officials have been hammering. First, digging into the numbers, the majority of categories declined, with furniture and car dealers leading. The weakness in bigger ticket items was echoed by Home Depot and Target earnings earlier this week. But Wall Street was concerned that gasoline sales would drag the headline down further than it actually did. The better than feared number is also buoyed by the upward revision to prior months, adding to evidence that the U.S. economy is not imminently heading into recession. Now, stripping out autos and gas for October reveals a surprise 0.2% increase. The so-called control group, which strips out even more categories, that is also up 0.2. Now, Americans were amped up. They amped up their personal care and grocery purchases. That latter group up 0.7%. Big jump there for 1 month. Meanwhile, restaurants and bar spending, that also looked positive, up 0.3. Now, the relatively strong yet not too strong numbers are in line with the latest thinking by Jerome Powell and his Federal Reserve cohorts. While Powell has been careful to say a soft landing is not his base case, that has become the de facto expectation on Wall Street. Meanwhile, today, we also got producer inflation numbers. This morning, final demand headline number that surprisingly dropped 0.5%. Street was expecting a small positive print there. Taking out food and energy, producer prices were flat month to month. This echoed the headline print from yesterday's consumer inflation print. As we can see on the charts, inflation has been trending in the right direction most of the year. That is down. We've had some pretty volatile results, but this uncertainty has at times, it has rocked equity prices. What we've seen, or what we've yet to see, is any kind of smoking gun that points to that all elusive imminent recession. So getting back to the Fed, we just don't have the evidence for more rate hikes, and the street is liking that.
Certainly liking that given yesterday's rally and the extending of those gains today. Thanks so much, Jared.